much are you prepared to give back before you recognise that you've misinterpreted a trend or a market? You talked earlier on, interestingly, about letting them just shrivel on the vine and just not putting any more into them.
We're on stop losses here, really. This, this is funny. I have a love-hate relationship with stop losses. It's like, it's just all through my investing career, it's dogged me, and I've never really been happy with the position I've come to with my understanding on stop losses, and I still find it a strange thing. Theoretically, I love stop losses. I think they're a brilliant idea in theory. In practice, they just do my head in. And one of the problems, it's like with cake, right? I put a lot of research in. I find a company I really love. I then buy the position. Something goes wrong, say it drops down, and I might have, say, a 15% loss, so I sell it. So I've just sold out of a company I really love that I think is a really brilliant company. I'm now out of it. And logically, that just doesn't make sense. And okay, they might have had a problem. They might have done a profit warning, and it might have dropped a load. It might be 50% down. But the point is, if I think cake is going to go bankrupt, then yeah, I need to sell out. And that's when a stop loss is a good idea. It's almost like just getting out and accepting you've taken the hit. But if you still think that cake is just going for a temporary bad patch, and companies do that, especially small companies, they do that all the time. They go through temporary bad patches. So to be selling out of them just because the numbers are, actually, logically, if a price has dropped, your shares actually got cheaper. So why are you selling something that's actually got cheaper? And I just find this a constant battle. My latest sort of incarnation of thinking is that on high risk things, I think stop losses make sense. I think on index trades where you're doing it, there's a difference between an investment and a trade. When you're investing for the future into a company like cake, like Patisserie Valerie, you're looking for a long-term future relationship with that company. So you don't want to be stopped out. You want to be in it. If it gets cheaper, that's your chance to buy more cheaply once it's got over its problems. This is one of my biggest frustrations. It's like several of the biggest, most successful investments I've had, and that includes Boohoo, which I've done fantastically on. I bought them, then they went wrong, and I'd be down 50, 60% on them. But it gave me, once they'd sorted out the problems and started to come out, I bought more of them as they started to uptrend, and I bought them really cheap. Boo I think my first buy in Boo was something like 70p. It went horribly wrong, and they dropped to as low as 20. But my next buy was 25p. So I got it massively cheap. It went, it's nearly £2 now. So it's stop losses. I can see why they're good, but I can also see why they're bad.
So you've talked about the times when you use stop losses and the times when you just don't think that it works for you. How do you utilise risk management? What is that to you?
Okay, well, the big thing for me on risk management is the number of positions and the diversification. So it's like, because I've got so many positions, my maximum risk, if a company goes bust, I'm going to lose, maximum is probably, say, 6%. If I had, like, Shell, RDSB is 6%. If that went bust tomorrow, I could lose 6% of my portfolio. So that's my maximum risk, really, if you think about it in those terms. In terms of, you've got two sorts of risk. You've got your idiosyncratic risk, so it's your risk for each individual stock. And that tends to vary on the size of the company and whether it's speculative or whether it's established or whatever. Smaller they are, the more risky they are. But then you've got like market-based risk. So that is your, as I said before, like if the overall markets tank, they often take the shares down with them. So there's two sorts of risk. So you manage the idiosyncratic stock risk by focusing on buying quality companies, buying good businesses that are making money and doing well. You buy loads of them, so you're diversifying across them and spreading your risk. You diversify across sectors, you diversify across market capitalization. So you've got FTSE 100, FTSE 250, smaller stuff. So you've got a spread of risk there. So that's all about risk management. You never have huge position sizes because you cut them if they get over 6%, And then on the market risk side of things, the main thing I try to do is to hedge, is to short. So, I mean, I had a disaster with it last year. It cost me in fortune. I just got it completely wrong last year. And funnily enough, that's why I've started using stop losses on index trades. It basically taught me a lesson. I've got to do it. What I did last year was effectively I shorted the FTSE 100, and it behaved really strangely because it became like a forex trade. It's like the FTSE 100 used to be an index of shares, but it sort of became a proxy for the weak pound. So the pound would fall and the FTSE 100 would go up, and I'd be short and I'd be positioned the wrong way. So that caused me a lot of pain. It's all about it. I've written all about it on my website, and I don't really want to relive it. But the thing was, it taught me an important lesson that you've got to treat your hedging trades as short-term trades, and you've got to use stop losses. So that's what I do now.
So why do most successful traders reduce their risk per trade as their accounts grow?
Yeah, that's a funny question. I mean, I'm not sure it's even true, but maybe it is. I think what tends to happen is as your account grows, you just can't buy small amounts of stuff. If you're buying an AIM company, I had a situation the other day where I was only trying to sell something ridiculous, like say, I don't know, I think it was about £3,000 worth of stock. Couldn't even sell that. I couldn't get it away. No one would buy it. You know what I mean? It was just ridiculous. So if you can't sell 3,000 quid worth of stock, how the hell are you going to shift a 50 grand position or something? So I think sometimes when your portfolio gets to a certain overall value or whatever, you're forced that you've got to have more positions. I mean, one of the guys that I know on Twitter and stuff, David Stredder, at Carmen's fella on Twitter. He's absolutely one of the best investors there is. He's a multi-millionaire. And he must have like 140 positions. And it's simply because, you know, your positions just become too big if you have less companies.